Everybody, Marty Mazur, good afternoon, March 8th, 2016. Down day for the market, first one in a few, so it should not come as too big of a surprise. I'll just tell you a little bit about what went on today, and then I'll finish up with the chart. The price of oil was down over 4% today, and while I don't think the correlation is as tight as it's been, it certainly is still there. And so I think that had more than a little bit to do with today's sell-off. Plus, the stocks that have just been rip-roaring, a lot of those are commodity-related stocks, took the biggest hit today. Stocks that started the year with relative strength, the utilities, more defensive things like staples and telecom, they actually had a good day, a very good day relatively speaking. So kind of a reversion to the mean. That should also come as no surprise because again, it's been a very substantial rally in those beaten up stocks and those beaten up sectors. China overnight announced that export numbers were disappointing. I think that weighed on the market going in. I just a little while ago looked at iron ore shipments to China. They're down, and the prospects, so certainly the projections for iron ore toward the end of the year are down. I think that weighed on the commodity complex in general. And again, so what has been kind of fueling the market's fire a little bit probably wanes a little bit from here. I don't know that the commodity bear market is completely over, that we've had enough in terms of capacity cuts to really justify the big rally that we've had. If I showed you my metals charts, almost without exception, we've seen some real nice bounces off the bottom. As I've said to you throughout the last few weeks and months about commodities, bottoms can be volatile. It can take a while for them to form. We should be encouraged though, and it's that late cycle, when the Fed is raising interest rates later part of the cycle, where we tend to do better in energy and other commodity-related companies. So I still think that's going to be the case going forward, but I just think this market lends itself to a tremendous amount of volatility this week. The European Central Bank meets. It's highly expected that a whole lot of additional monetary stimulus is going to be announced. That could be a good thing if indeed it is. If it's not, could be reason for the markets to sell off as well. From a technical standpoint, last couple of presentations I introduced you to this rising wedge pattern and told you that technically speaking, that is a bearish move, and to expect to possibly expect that we would possibly see, or maybe it was highly likely that we would break out of that. And sure enough, that's what's just happened. And then I told you that if we do, we're going to trade lower and test some key support areas. Today it tested that very important 62% Fibonacci retracement level, and that's retracing back up to the recent high. It had been resistance, and then it was support, came back, and you can see it's had two tests, well, more than that if you go back to here, and it's shown that it is support. So technicians, could be gearing up for something good to come bouncing to the upside tomorrow. I wouldn't bet big either way. The market, by some measures, got overbought here, so that also made sense. Some short-term technical measures would suggest that there was some overboughtness, not extreme in my view, but that all led to the technical view of the market as we sit here today. If oil continues to crater tomorrow, my best guess is stocks would crater with it. We've got this channel that's pretty well established right here, so it wouldn't be a surprise at all to see us come down and bump against that. We could, as I've said for weeks now, easily find lower lows in this market before we come up and close these gaps and move up to all-time highs once again. That day will come. I just can't tell you when. I can tell you there's a lot of things in the way. The market has some real tailwinds. I told you about the breadth being very bullish for the market. The economy is looking better. I've seen some pickup in businesses, CapEx or capital investment, meaning investing in productivity, which we need in the worst way. But also today, the small business optimism index was as low as it's been in a couple of years. So there's enough uncertainty to maybe keep the Fed at bay and to keep them from being too aggressive. When it comes to raising interest rates this year, the market should like that, although we are seeing some inflationary signs. We're certainly seeing it begin to pick up in some of the commodities. So folks, I'll say, as I said, I think over the weekend, I think the risk is pretty balanced in the near term for the market. I can make a case that it goes higher, both technically and fundamentally, and I can make a case that it goes lower. So us long-term investors, good thing is this doesn't impact what we do with our portfolios. We just stay diversified, and hopefully, if you're our client, our goal is to keep you in the right buy or keep you with the right biases from a sector standpoint to take full advantage of what's going on in the world. Thank you, folks, as always, for watching and listening, and I'll talk to you very soon. Bye-bye.